Good evening.
Good evening, Professor.
Hello, hello. We start in 10 minutes, so I'll switch everything on off now. Hello. So it's 6:30. So let's get started. My name is Dmitry Rybych, and this course is business valuation. We'll be discussing that for April and May, and some of June. We'll have 8 sessions. And now I'll begin with some general information about the course, about what we're going to do, and what you can expect from the course. But before I open my presentation, I'd like to post a link. 1 second. This one. You can open this link later or now, doesn't matter. Now, 1 second. Open the presentation. So the first thing I'd like to say is that we'll be using this platform, edu-altinvest.ru, for all communication, all documents, all communication between you and me. So you should register on this platform and sign for this course, for this link. But 1 second. Okay, I'll send you later a code to register for this course, because you cannot just register to this course. It's for you, and this is not an open course. In this, this is actually not a complete course. That will be our repository, our cloud for all files, like, for example, lecture slides, and so on. And on this platform, you'll find quizzes after each session, and later I'll explain you the role of this quizzes in our work. So we use this cloud for all communications, and of course you can write me by email if you have any question, and so on. And let's go to the content of the course. So all necessary information will be given in our lectures, but of course you can find much more in other sources. And what would I recommend is, first, if you want to get just another look at this topic, watch Damodaran video lectures on YouTube. On YouTube, Damodaran has several valuation courses, but you should take the one from 2013, because in 2013, Damodaran recorded a course of brief videos specifically for YouTube. All the other courses are too long and boring to watch, but this one is prepared as video course for YouTube, so you can use this as another version and as another approach to read the books. But you can, of course, you can use Damodaran's book. The most appropriate book for our course is Damodaran on Valuation. He has some other books. So Damodaran is the first author I would recommend. The second source for you would be CFA
program curriculum. As far as I know, you have access to CFA textbooks. Is that correct? Could somebody answer? Do you have textbooks from CFA? Yeah, okay. So for level 2, in level 2, they have equity valuation module, and we try to be as close as possible to the curriculum of CFA Institute. So in my course, I'll be presenting valuation approaches and so on, in most cases based on the approach of CFA Institute. So we'll be close to this level 2 equity module in CFA program. And the third thing you need is access to Refinitiv Icon. And again, as far as I know, you have student access to Icon. The only thing is that recently they changed their policy. So in the past, in Icon, you had some limited, but still had some access to professional equity research reports. Now, as I afraid that in your copy, in your subscription plan, you don't have access to those
research reports, but at least some reports you can find there. So you should use Icon for 2 reasons. First, just to learn how to use professional information system for your work, and the second, to find research reports there
and to look at those reports as an example of what you should do in your course. Okay, so we have, as
I said, we have 8 lectures. Today we'll discuss some general questions about valuation, and we'll start from the most primitive basic approach to valuation with discounted dividend valuation approach. Then the next lecture will be about return concepts, discount rate, basically, and everything that work behind discount rate.
The next will be free cash flow valuation or DCF analysis. Then it will be market-based valuation. Then we'll take a real company and analyze this case from scratch to the eventual valuation for this company. In this session, I expect that you'll be using your computers not just to look at what I do, but to do your own cases. But actually, after we switched last year, we switched online. Last year we couldn't really work in Excel during my lecture because we use computer to
watch, and you cannot use the same computer to do your samples. So we separated the lecture part from all case studies. But anyway, you'll be having this experience with your project. So then we'll discuss everything that comes before we have a financial model or before we have any calculation, any financial calculation, things like industry market analysis, all that influences our financial expectations. Then there will be
a lecture on private companies and the wrap-up session with the final exam. So the assessment throughout this course will consist of two things. First, this this first part is just 30% of your final mark, but I believe that this is the most important part of the whole course. I mean, more important than the lectures,
than the exam, and then anything. The valuation report. In this valuation report, that will be a group assignment, and you prepare a valuation report as complete and professional as you can on a subject company, and in this valuation report, you'll apply all major approaches, all major methods will be discussed throughout the course. And at the end of the course, you'll have the final exam. This is just a written test, multiple choice plus 2 questions to build a simple model or build simple calculation, and that will be 70% of your final mark. And as I said, on the platform Edu Altinvestor, you'll find some quizzes after each or most sessions. You should pass those quizzes, and you'll not have any specific mark from these quizzes. So they are on pass-fail principle. But if you haven't passed all the quizzes, you'll get -5% to the final mark. So this is just pass-fail quizzes to see that you actually hear. Because the problem with this format, with distant format, is that I don't even know that you hear, that you listen, that you participate in everything we do here. So those quizzes help me to see what's going on in the class. Because most of our course will be this group work with the project, with your evaluation report. I think it's important to say one thing. If you make errors, that's okay. In some cases, sometimes if a group submit their report earlier, I can even give you another iteration. I can give you feedback on your final report, the report you expected to be final, and you'll have a chance to improve it. And anyway, you have many chances to submit intermediate reports, models, and everything. So you can always fix everything in your report and your work, unless you did one big mistake, unless you took someone else's work and presented it as yours. So in case of plagiarism, I react only one way. I put 0 mark, and usually don't discuss this matter. I mean, changing something, submitting new version, and so on. So that must be your own work. And to make sure that everything okay with plagiarism, with absence of plagiarism in your work, remember the following. First, when you work, and that's not just for this course, for your professional work, that's also very important. If you do something, for example, if you analyze a company, always keep a local copy of everything you used. If you, for example, if you used financial reports of the company, store these financial reports in the folder for this report. If you used some other publications and so on, always keep records. For two reasons. First, in terms of plagiarism and things like that, to be always able to prove that you did this work yourself. And second, if you asked about something where you took some data, that's not for our course, but you have situations like that in your professional life. If you ask to explain where you took some data, you should always be able to present your sources, and you should not be dependent on availability of those sorts of changes of those sources and so on. So always keep your local copy. Please send all intermediate results to me for feedback so that I could fix your errors as early as possible, and to help me to see that this is your work, you are working on this report, on this model, and so on. And if you copy anything from any source, maybe more than 3 words, if you copied 4 words from somewhere, always put reference to this source. You can skip those references only if this source is obvious. Something like, I don't know, if you use official currency rate, we understand that you probably took this official currency rate from central bank website or source like this, and you don't need to put references for such information. But for all other words, please always add reference, add correct reference, correct? And you should never copy anything from reports or models of other students. Even if you decide to copy and then change it, don't do this. You shouldn't copy anything from your own previous work without the reference. And you should not copy anything from any professional equity research report. In some other cases, it probably would be a legal, I would say, source. But for our course, you should not copy anything from equity research reports. You can use everything that I used in the course without reference, just again because the source of that is obvious. But if we talk about models, for example, you must understand that if you used the model from the course without any change in this model, then your own work in your assignment will be minimal. So your mark will be lower because of that. Our group assignment. So the first thing, we will use one and the same subject company for all groups. And this year, this company is Volkswagen. So the company we are preparing a valuation report for is Volkswagen. Of course, you can find any information about Volkswagen on their investor relation web page or website. So you can start reading about the company, collecting information, and so on. Group size, I expect to see, is between 3 and 5. And I'll post, I didn't post the link for the groups in my LMS, but I'll do that maybe today in the evening or tomorrow. And I expect that by the next lecture, I will know all the groups. So you'll have the table, there'll be a link to a Google Sheet, and you can write in your names for the groups. This group assignment should be submitted before June 22. So the deadline is June 21, 1 minute before the midnight, for late submission until 6 p.m. The next day. You have -5 points of total 60 points for this assignment. And if I get the assignment after 6 p.m. the next day, you can actually don't send it because it's 0. So the deadline, please take it seriously. The deadline is 22nd of June. Okay. 1 second. Somebody has the mic switched on. Please, could you switch all the mics off? Or I'll do that. Okay. Okay, now let's start with the content of the course. I'd like to start with an example. 2 years ago, Sberbank sold its subsidiary, Denizbank, for $2.8 billion. And this deal, this $2.8 billion, was at discount with to some price that was agreed before, but there were some negotiations on that, and there were some factors that influenced the price for this deal. Those two factors were first changes in Turkish lira. Denizbank is a Turkish bank. First was change in Turkish lira, and the second reason why the price was was, of course, sanctions. Sanctions against Sberbank. That's why Sberbank sold this bank, this subsidiary, actually for the price lower than they spent when they bought Denizbank about 5 years before that. So the question is it market value? And is it fair value? Or is it fair as a deal? And this question can be answered in many different ways. And first, let's discuss, is it market value? For market value of a company, we usually use some information from the market, if this company is public. And formally, Denizbank is a public company. Denizbank is a public company, but the problem with Denizbank is that free float for Denizbank is just 0.15%. That is virtually zero, right? Do you know what free float is?
Yeah, the share of stocks that traded publicly on the stock exchange. So with 0.15% of the stock traded on the exchange, we understand that what happened on the exchange with this stock actually doesn't matter, because roughly 100% of this company is owned by one company, one investor, and that's Sberbank. And actually, I don't understand why those stocks were still traded until Sberbank sold the company. It's maybe just like some noise. So the first thing here is that we don't use market value. So let's return to my question. Was this deal a market price, a market deal? I don't know. There's no such thing as market value for this bank. And was it fair? Maybe it wasn't fair for Sberbank as an investor, as just financial investor, because of sanctions, because of other influence from the outside. But we will use this for this deal. We will use the term fair. And now let's discuss all definitions of value that we'll be using in this course. So first, market value. So what was that price a market price? No, that wasn't a market price, because formally the market price is just the price of a share times the quantity of shares, and this is market capitalization or market price. So we'll use the term market price only for traded stocks with sensible share price. In this case, we have a share price formally, but we can use it, cannot use it in our variation, because we understand that that share price was probably quite random. The second definition of value, intrinsic value. Intrinsic value is the value of asset or of a company given an idea that we have complete understanding of what this company can give us, what it can generate as our cash flow, our return, profits, whatever you call it. So intrinsic value is the value that we actually want to know about the company. And usually when we apply DCF, discounted cash flow approach, we're trying to calculate intrinsic value. But the value we get from our valuation is not the intrinsic value. And that's another important thing. Nobody knows the intrinsic value, because nobody has complete understanding of a company. We always have our predictions, expectations, forecasts, but not complete understanding of this company. So when we're trying to calculate intrinsic value, we actually get estimated value. Estimated value, it is our estimation of the intrinsic value. Now, so the company has market price, and the company has intrinsic value, and we can estimate this intrinsic value. There are two other types of value. Fair value. The fair value is the price that well-informed and acting freely seller agreed to sell for, and well-informed and acting freely buyer agreed to buy for. So in the case of Sberbank and DenizBank, we can call this price, this $2.8 billion, a fair price. Because yes, the reason why the price was lower than it would be possible in other circumstances was because what those sanctions and so on. But the sanctions were not a part of the deal. So in this deal, Sberbank acted freely, and we will call this price fair value, or fair price. And the last type of value is the investment value. The investment value is the value that somebody is ready to pay for the company, taking into account not just what this company gives by itself, but also some potential synergies or something that this investor can get from this investment. For example, if I have a, let's say, I'm buying a port, just some small port, and this port doesn't generate a lot of cash for me. But I understand that I can invest some more money in this port to increase its capacity, and then I will use it to export, to deliver some goods I'm producing. Without this port, without this basis, sorry, 1 second. Okay. Without this port, I couldn't earn revenue from my main business line. With this port, I can get more revenue from my manufacture and so. So for me, for all the others, for those who want to get revenue, get return from the port itself, they would probably value this asset much lower because it doesn't generate enough profit. But as I have goods to deliver and I have no other way to make this delivery without some port facility, I will value this port higher than the others. Okay, so we have several different definitions of the value, and what definition we would like to use when we invest in. The first idea probably would be we need to use the market value of the company, and the market value is something that tells us about this asset enough. But the problem is that actually the market value can be incorrect, and even more, for most companies, the market value most of the time incorrect to some extent, because the market has inertia. The market doesn't react to what happens to the company, doesn't react quick enough. Sometimes the market just actually doesn't do valuation for
for a company. I mean, by the market, I mean all market participants. So in many cases, we can find a source of additional return, of additional profit for us if we do valuation of the companies and if we understand the market, the intrinsic value of the company better than the whole market. And we can see how far this difference between not the intrinsic value, but between estimated value of companies and the current value of current market price for companies, how far that goes. This chart, it's published by Morningstar, and this chart shows us the average difference between market price of the stocks. They use something like S&P 500. I actually didn't check how they selected the list for the stock, but I expect that this is something like S&P 500. So this is the difference between market price and estimated price. We would say intrinsic value, but we understand that we don't know the intrinsic value. We know the estimated value. And you can see that in 2017, Morningstar believes that the market was overvalued. Then in 2018-19 and in the beginning of the epidemic, the market was undervalued. Now it's again overvalued. So is it correct? Is the market overvalued today? Should we short most of stocks today to earn profit, or no? Let's look at the last year of this calculation, and you can see that they believe that in the beginning of pandemic, in April and May, the market was undervalued. Now it's overvalued. But to understand the content of this chart, you should take into account that they compare the market price and equity reports. So what we see here actually is that first 2 months, investors reacted to the pandemic. So the prices fell, but most equity research reports still had higher prices. And now equity research reports all have lower prices. And because of that, we can see that the market looks overvalued. Maybe the analysts are right, and we actually have overvalued market now, but maybe they are wrong. They just were too slow to react. So now they are too pessimistic, and the market may be priced fairly, or maybe even undervalued. We don't know. So we never know. We never have one definite source of information about the value of the company, and that makes some space for us to do our own valuation and to get profit from this valuation. So this is the basic idea of why we do valuation and how this market looks like. And the problem with those slow changes in analyst reports are not the only source of problem for us. Here's another example. This chart is the share price for Transaero. Transaero is an airline that went bankrupt, technically went bankrupt Legally, they were not bankrupt in 2015, but technically they went bankrupt in October 2015. And you can see that a year before that, not year, actually 6 months before that, their shares had price about 2010 or 210. Then it fell for 6 months to 7 and actually disappeared. Could we predict that? Yes, we could. Because if instead of using market information about their shares, if we did valuation that time, we could see that this company cannot have any value, just cannot have value, because they weren't profitable in 2014. That was long before this crash. They have officially, from their public reports, they had like 1% profitability. That was about 0, and it was hard to say how they can give any profit to their investors. Then they updated their financials and restated in 2014. In their report for 2014, they restated their financial reports and disclosed that actually in 2013, previously they showed, you can see, they show that they have 1 billion rubles of net income. But then they updated the previous report and said, you know, actually we have -16, not +1. And in 2014, they had net income -19. And what's strange in this case is that this report for 2014 was published in was published in April 2015. So this first drop on the chart from 210 to about 100 was after this report was published. So after that, their shares was still priced at 100 rubles per share. Although from their financial report, we can see that this company just don't have any value, anything. And that's of course that looks strange, but this is another example of how the market is slow to react to the information they see. So that's another example of what can happen to the stock on the market. So we should never believe in market price as something that we can use as actual valuation of the company, and that's why we do our own valuation. The general process of valuation consists of the following basic steps. First, we should understand this business, understand what stands behind its financials, what influences their future sales, revenues, profits, and so on, their market position, their competitors, their cost structure, their investments, made investments and expected investments in the future. And we'll see in some examples that for many companies, just using financial reports as the source of as the way to value the company isn't enough. Absolutely, just because the most important things, the most important for the value of the company happens far in the future. In this future, their current financial reports will have no influence to financial reports 10 years from now. But it's important for us to understand what will happen to the company 10 years from now. And to understand that, we should go deeper than just to financial reports. We should analyze what drives the company's performance, what drives success or failure of this business. So we should understand this business and understand the drivers. The second step, we should forecast financial reports, actually. Forecast its sales, costs, investments, financing, and eventually dividends or profits. Then we select the valuation model we use for this company, and that will be our next topic now. Then we apply this valuation model to this financial projection and calculate expected value for the company. And the last step, when we have the value, we can come to some conclusion. And we can conclude that we would like to invest in this company, or we would like to sell it, and so on. So this is the general process we go through for any valuation. And we'll discuss that in our lecture about the market. But what's understanding the business? Understanding the business consists of current and expected market price, current and expected general economy, cost structure for the company, absolute cost structure, I mean just profitability of this business, and relative profitability of this business as compared to their competitors. So this is what we want to know about the company. To collect this information, we usually gather things like market price reports or indicators, other analysts' reports, the company reports. Every public company publish not just their annual reports, and in the annual reports you can find often you can find useful information for your understanding of this business. But they also publish different management reports, other supplement information. And from this information, you can collect a lot of facts about the market, about the company, their competitors, and so on. And we can do the same for their competitors. So if, for example, if I'm analyzing Volkswagen, where can I find information about the market of Volkswagen? I can start from their own annual reports, but then I can go to annual reports of their competitors to see how they forecast the market, what they expect, and how they see Volkswagen as their competitor. So by collecting this information, you start understanding the business, and you will be able to prepare financial reports, financial projections for this company. But when we collected information, we'll skip this part for now, because we'll start from more mathematical part of the valuation. When we collected the information, when we prepared our financial forecast, we can start valuing the company. And there are several approaches. We have many methods, but they all fall in one of these four, actually three basic approaches. First, DCF analysis, discounted cash flow, or income-based analysis, or free cash flow analysis. Actually, this is income-based analysis, or DCF. So DCF, the idea of this approach is that the company has value formed by expected future cash flows generated by our purchase of this company. So if I buy a share, the value of this share defined by future income that I will get from this share. And the same is for the whole company. So this is the first approach. The second, relative or market-based valuation. The value of the company, or the price of some asset, or share, that it can be share or any other asset, depends on what people pay for assets like this. So this is how we, for example, do valuation for apartments or for any real estate. We don't calculate any expected income from this real estate, especially if we buy it for ourselves. We don't calculate, we don't take into account how much it took to build this building. No, we don't use this information. We just collect information about how much people pay for apartments or houses like that. And the same way we can value the company. So relative valuation assumes that the value depends on market prices for such companies. The third approach, asset-based. With asset-based valuation, we declare that the company consists of some assets, some underlying assets of this company. So when we buy a share, we buy actually some part of the company, and the company consists of plant and equipment, things like that. So with this approach, we can calculate another version of value of the company. And the fourth approach, this is actually not an approach in most valuation methods or valuation regulations. So for most valuation regulations, you will see that there are three valuation approaches: DCF, relative, asset-based. But CFA Institute ignores asset-based valuation. I'll explain you why. And instead use sum of the part valuation. And with sum of the parts valuation, we just decompose the company. If the company is complex enough or too complex to create decent forecast for the whole company, okay, but we can split this company into several simpler businesses, value each of those businesses, and then sum all these values. And basically, if we split it, the business up to each piece of equipment, for example, that will give us asset-based valuation. But usually nobody
mix these two approaches. So some of the parts means splitting the company into 2, 3, 4 separate businesses and valuing each business and then summing them up. Okay, so these are 3 valuation approaches that one can use. But which of this approach give us the best value, the best estimation of value of the company? Which approach should we use? Or maybe we should calculate value of the company using several approaches and then calculate some average or weighted average of these approaches. And that's actually what people do in many cases, and you will do the same in your valuation reports. So people calculate company's value using, for example, DCF and relative valuation approach, or DCF, one DCF approach and 2 relative valuation methods with different indicators as basis for the valuation, and then calculate weighted average with some weights for each approach. But you should be careful with that. That's the way we do it. But you should be careful with that, and that's why. Look at this figure. This is a projection of something, yes, and this is another projection of something, and actually they are projections of a cylinder. But if you look at the first projection, you'll see that this is a circle. The second projection gives you a look like this is a maybe it's a cube. If we calculate average between circle and a cube, or on this projection we see a rectangle, so maybe the original thing was a cube. They both give you incorrect presentation of the original figure, and unfortunately the average between them will give you even more incorrect presentation of this figure. So this is the way our valuation approaches work as well. They give you some projection of the company, and more methods will not give you better valuation. The best approach is to understand what is the reason why you value in this company, and apply the approaches that are the best for your reason, for your plans. And for example, we'll meet this later in the lecture. But for example, if I'm going to buy the company and hold it, so I'm not going to sell this company, then probably income-based approach would be the best for me. And relative valuation, market-based valuation, has just nothing to do with my plans. So there's no value for me in this approach. So I will skip relative valuation probably and use income-based valuation, DCF approach. But if I'm buying a company and I'm going to sell its shares, I am buying some shares and I'm going to sell them in 3 months or in 6 months, then probably discounted cash flow of this company
is very interesting for me. The thing I'm interested is what value the market, what price the market will pay for these shares in 3 months. So the market-based valuation would be much more interesting for me than any DCF approach, and so on. So we will use weighted averages of several valuation models, several valuation approaches, but you should be careful with that, because this is not an ideal way to calculate the best price or the best value for the company. Okay, let's discuss each valuation approach separately. So the first, DCF, discounted cash flow. So with discounted cash flow, with income approach, we forecast the income we'll get from this investment. And to understand how it works, I would like to replace shares with bonds. How we calculate fair price, expected market price for a bond? Bond is a very simple for analysis. I mean, plain vanilla bond without any I know, options and so on. Just a bond. This bond have par value that will be paid in the end of the bond period. It has coupon rate, and this coupon will be paid annually or every 6 months. In this case, in this example, coupon is paid annually. So 5% coupon rate. And now to understand how much we would pay for this bond, we should decide how much we'd like to earn with this investment. For bonds, it called yield to maturity, YTM. So if I believe that I would like to invest in this bond, if I expect to earn 10% on my investment, 10% annually, then I use this YTM. One second. Then I use this YTM as discount rate. I calculate discount index for each period. Then I construct expected cash flow for the bond. Each year, this cash flow, every year it's just coupon paid for the bond, except the last year where we expect to get coupon and par value. And now I just discount all these cash flows and get the current fair price for this bond. This is how it works. And the same way it will work with a company, with a business, or with share. The only thing that changes is that this cash flow is harder to predict. This cash flow will be taken from our financial forecast for the company, and the financial forecast of the company is much more complex thing than just payments for a bond. So this is the only difference, and of course, because of that, we expect that this YTM, or this discount rate, this required return for our investment will be higher, because why would we invest in such an unstable cash flow stream, if we don't have expected additional profit from this investment? So of course, our expected cash flow for the company for shares will be higher than for a bond, but the principle mathematically is the same. What should we understand about these expected cash flows, this forecast? First, we buy this company, even if we buy a company, buy shares and plan to sell it in a year or in 6 months, in the analysis, in valuation, we use long-term expectations for this company. So when we say that expected cash flows from our investment is what defining the value of this company, we saying about the long-term expected cash flows. And here is, for example, cash flows for Amazon. Oh, not cash flows, net profits. And you can see that for many years, Amazon was an unprofitable company. But that doesn't mean that during those years, it has negative value. It had positive value that years because investors expected that Amazon would generate profit in the future. And that's why financial reports that we have now for a company, in some cases, in many cases actually, mean nothing for us, because to build our valuation model, we will use not the past, and financial reports are always about the past. So not the past, but the future. And in the future, we can expect that current financial position of the company will change dramatically. So we should prepare long-term forecast of the cash flows, and those long-term cash flows will be our basis for valuation. Another thing you should know is that in most cases, when we're talking about businesses, about value of business, we use terms, we use indicators from its profit and loss accounts, from its income statement. But and that's okay for most companies, but you should be careful with using income statement as the basis for your valuation, because we use income statement, but we expect that we get cash flows from this investment. We get cash, and there are cases where we have income, we have good profit for the company, but actually this company doesn't generate cash. Look at these two examples, company A and company B, their revenue and their profit. What do you think? Which of these companies is a better investment? A because yes, because A has higher profit, right? But now let's look at bigger picture for those two companies. So the first company is manufacturing company, and to continue producing whatever they produce, they need to invest in their equipment. And let's say that this is their expected capital expenditure, and as a result, their expected free cash flow. And the second company is consulting company, so they have small capex, and their free cash flow is pretty close to their profit. And what do you think now about those two companies? Now B looks better, because with B company, you'll get more cash from your investment, although the first company looks like generating more profit. Of course, in real life, it's a bit more complicated, because your capital expenditure will influence your profits. So it's not usually the case that a regular company with stable size of business have high profit but low free cash flow. I mean, higher profit than the other and lower free cash flow, because capital expenditure doesn't influence net profit directly, but it influences net profit indirectly through depreciation. But there are cases when the company we're analyzing has profits, has profit, but doesn't have free cash flow in the future, especially in the future, because of expected investments. For example, I'll give you an example. I had a company for analysis a year ago, and that was a bus company. So it operated about 400 buses. And the company had some small but positive net profit. But the problem was that for the last 6 or 7 years, they didn't buy new buses, new vehicles. So what the company had, because you didn't buy new buses, you depreciated all your car park. So in your net profit, you don't have any influence from your necessary investments, because all depreciation was drawn down in the past. Now you have nothing as depreciation, and your financial report looks profitable, but actually in the future, your future is pretty dark, because in the nearest future, you will have to replace your whole car park. So you need huge investments, and you will not have any free cash flow in the next several years. And actually, with revenue like today, you will have no profit anywhere in the future. So you have to change something in your business, because with business like this, you are unprofitable. So this is something that happens in real life. So the first thing with DCF analysis is that we look at the long-term forecast, not at what we have now. And the second thing is that we are interested in the cash flow, not in the income statement. But saying that, in the next step, we'll go to our first valuation method, and what we'll be using is dividends based on our current income statement, and usually without any forecast in the future. So we use current dividends based on current net profit. That's why you should be very careful with methods like DDM, discounted dividend method. because we start with DDM only to show the simplest approach, the simplest application of valuation methods to some business. But for real life, for real valuation, people rarely use methods like DDM. So this is more for textbooks, not for real life. But today will be used. Okay, so if we use this approach, this DCF analysis, what's good and what's bad in this version? First, what's good in DCF analysis? If we analyze the company based on income approach, then we can we don't depend on market. We don't depend on market, and that means that we can use this approach for any revenue generating business. It can be private company, public company. It can be even not a company, but just a division of the company. It can be any income generating asset. So for all of those assets, we can use the same approach. So this is the first good thing. The second, we were discussing that the market isn't always right about the price. So if the market is biased, then with DCF valuation, we can see this bias, we can see the error, and we can make profit from our understanding of this business. And the last thing is that DCF valuation is actually the only way that leads us to, maybe not to intrinsic value, but to our attempt to get intrinsic value, to our estimated value of this company. And fundamentally, this is the most correct approach to investments. We should understand the intrinsic value, or try to understand the intrinsic value of any asset and invest based on this information, not on what market believes or whatever. So theoretically, this DCF approach is the most correct approach. But why we don't always use DCF valuation? Because first, it's just costly. It takes time. It takes a lot of time to build financial model, to collect all information for our assumptions, to analyze all that, and to calculate the outcome that we can use in our investments. So the problem is that if you have just one company, you're preparing a deal, you going to analyze this business deeply and thoroughly. Yes, DCF valuation is a good way to do it. But if you thinking about your 20 shares to buy tomorrow, it's hard to build 20 models and to analyze intrinsic value or make DCF analysis for 20 companies. And you probably need even more than 20, because if you want to choose 20 shares to buy, then you will probably analyze 100. And it's just impossible to build financial models for 100 companies. I mean, for one person, for one analyst. So you should either believe other people, and that means that you just don't do evaluation for those companies, or you should find
simpler, a better way to quickly calculate the price that you're ready to pay for shares. So the first problem with DCF analysis, it's just too complex and costly. And the second problem is that DCF analysis is a powerful tool to value the company. But this power isn't necessarily a good thing. Having dozens of parameters for your model, you have unlimited possibility to make mistakes. Or if you looking at the others models, they have unlimited possibility to manipulate their model. So the extent to which you can believe in the result of this model is that big. So it's dangerous to believe in a financial model that becomes less and less transparent while you going from a very simple calculation to a big fully fledged financial model. So this is a disadvantage of this approach. Okay, but we have another possibility. We can use relative valuation. What relative valuation is? With relative valuation, we find other companies that look like our company. We collect information about prices for those companies, and then we calculate expected fair price for our company if those companies on average are fairly priced. So the idea is that our company can have incorrect price, can be unfairly priced, overpriced or underpriced, but on average for the market or for some niche on this market where our business work, for this average price, we will have much better valuation. So the market prices there, they fairly, maybe not absolutely correct, but better than one company. So our company should be priced as the average pricing for the similar companies. And the idea here is to calculate some multiple for based on this average pricing, then apply this multiple to our company and calculate fair price for the company. And the first advantage of this approach is that it's much simpler than for DCF analysis. So we can quickly calculate expected fair value or our valuation for many companies. And this is the first good thing. The second thing is that market-based valuation shows us not what we believe about the company, but what the market believes about companies like that. And that's important because imagine that you are very smart. You're so smart that you know something about the future of a company that all the others on the market just don't see. That's good. And what if you buy this share and hold it, and in 6 months you're going to sell these shares? You can earn something on this,
only if for these 6 months, the others on the market will see what you saw 6 months before. But what if not? What if you're right, this company has bright future, but this is some distant future. In 5 years, this company will be much more profitable than now. But it makes no good for you if the others still don't understand that in 5 years, this company will earn more than it earns now. And if the market doesn't change the price for the shares, doesn't understand what you understood 6 months before, then you earn nothing, right? So with DCF analysis, with intrinsic value, that can be a problem. Too long-term forecast, too long-term expectations will not change the price of shares now, this year, or year from now. And with market-based valuation, you use a much simpler idea. Here, the idea is that, look, if 5 other companies like mine are priced much higher, their shares as compared to their profits or whatever, their shares have higher prices, but the company I'm analyzing has low price now. Okay, I can buy it and expect that 6 months or a year will be enough for the market to see this difference and to adjust the price for my company. So market-based valuation shows me the difference between pricing of my company and the other companies that probably will be corrected by the market in the nearest future. So for short-term investing, for medium-term investing, market-based valuation can show me a better estimation of fair price than DCF analysis. And the last good thing with market-based valuation is that with market-based valuation, I can calculate price for my company even if I don't understand this business. I don't understand why this company that probably have negative profit now or low profit now, why this business should be valued at high price. But if I see that all businesses like that with these parameters, with this, I don't know, sales, this users base, or something like this, they all have such value. So just by comparison of these companies and my company, I can calculate this, the value of my company, even without understanding of the underlying business. Just because I believe that somebody on the market understands this business and they set this price for the companies like that. So earlier or later, they'll come to my company and price it at the same level. This is advantages of market-based valuation. What about disadvantage? First, yes, we can believe that the market doesn't make mistakes on the industry level, but actually it can. In some cases, the whole market, the whole economy is overvalued or undervalued, or the whole industry is overvalued or undervalued. And in those cases, we'll make the same mistakes as the others on this market, and we'll get nothing from our time spent for valuation. So if the market is wrong on the industry scale, then market-based valuation gives us the same errors as with one company. The second thing is that with relative valuation, we use very simple multiples, things like price to earnings multiple or things like that. But although we hid from ourselves the fact that we use discount rates, we use expected growth rates and things like that, they are there. They are inside this multiple. And when the others set their value, their prices for those companies we use in our relative valuation, they actually had in their mind some expected discount rates or expected rate of return, other parameters. And that's why they set those multiples at this level. And if we just believe that it's okay for us, if it's okay for the whole market, it's okay for us, that can be wrong. Sometimes it's okay for the others on the market, but it's not okay for us. We cannot use discount rates like that and so on. And that's why the market-based multiple isn't okay for our case. But we don't see that because we've hidden all that inside one parameter, inside this multiple. And the last thing that bad with market-based variation is that we usually, with market-based variation, we usually take one parameter like profit or revenue, sales, or assets, and use this one parameter to calculate expected value of our company. But life is more complex. In real life, the company's value depend on many parameters, many factors, and this simplification can spoil all our valuation process. Because we compare, we find other companies that look like our company, we compare them, recalculate values based on just one parameter, but it's not enough because our company has other differences and we just don't see them in our valuation process. So basically, market-based valuation is simplified, quick, and too rough in many cases. But sometimes we have companies to value that cannot be analyzed with DCF analysis and cannot be analyzed with market-based valuation. I'll give you a couple of examples from my practice. The first company is Battletrans. Battletrans is a manufacturer of reinforced concrete tires for Russian railways. And the problem with this company is that this is the only manufacturer of concrete tires in Russia. So we cannot find any comparable company. Even more, this company has just one customer, because yes, there are private railways in Russia, but private railways usually they are small and they use wooden tires. Concrete tires are used only for main lines, and all main lines are owned by Russian Railways. So this is one manufacturer for one customer. There's no market price, no competitor, no comparable. And that means that we actually, we even cannot forecast their cash flows, because with no market price, we can expect that next year the price will generate profit for them, or it will generate loss for them. It depends on their negotiations with their only customer, and so on. So this is one example. Another example, first non-metallic company, and this is from the same business. This company manufactures crushed stone, and this crushed stone is sold to Battletrans to produce concrete tires. So they have the same problem. Yes, there is a market for crushed stone, but they produce specific crushed stone for Battletrans. So again, just one customer, one company producing this type of crushed stone, no market, no competitors, no comparables. How to value companies like these two? The only way to do it is asset-based valuation. For these companies, we can calculate fair price for their assets. For the first company, this is market price for their plant and equipment. For the second company, this is market price for their stone deposits that they use in their manufacturing process. So we can calculate this market price for their assets, subtract their liabilities, and we get the only available valuation for companies like that. So if we cannot forecast cash flows, if we cannot find comparables, we can at least calculate the price of their assets. But for most companies, for most businesses, asset-based valuation isn't recommended, because what would you lose in the business of the company if you believe that the value of the company consists of value of its assets? Yes, Igor, I mentioned that we use not price of value of assets from the balance sheet. We use market prices for assets and subtract market price of their liabilities. And what will we lose? Okay, look, first, yes, but future cash flows are generated by Samsung using their assets. If we use asset-based valuation, we believe that company consists of Samsung. The company is a business with their assets, but there are assets that will never appear in our asset-based valuation. The first, a very simple example, people. It's 150 years from the time that businesses stopped having people as assets, right? So your employees will never be valued in any valuation like this. If you have a team of good specialists, you can never use this as a part of your valuation. The second, your clients. If you have a client base, and with this client base, with these customers, you can generate future revenues, but you cannot calculate value of this relationship. Third, yes, in-house R&D, for example, if you have technology, any intellectual property that was not bought from somebody, so that you can show the price of that and report this value on your balance sheet. So in most cases, your intellectual property will not be presented on your balance sheet, and your trademarks. In some rare cases, you can show the value of your trademark on your balance sheet, but in most cases you can't. So with asset-based valuation, you miss a lot of things in your business. So even if you believe that the business is just a bunch of assets, you cannot see a lot of real assets of your company. So that's why for most cases, asset-based valuation isn't a good approach. But sometimes when you have no choice, you can use it. And the last approach, again, example, there's a milk holding, dairy holding in Russia, with very creative name. It's a dairy holding, milk holding, with the name Milk Holding. So this is not the description of the company. This is the name of the company. This holding consists of 4 dairy farms, and those 4 dairy farms are in 4 different regions of Russia, with pretty long distance between those 4 farms. So they work actually as 4 separate businesses. If we need to value this holding, if we need to analyze it, should we analyze it as one business, or we can present it as 4 separated businesses? Of course, we can separate them. We can create 4 financial models for 4 businesses. That would be easier to deal with. And for case like this, we can calculate value of those 4 farms and then just sum them up. And this is the idea of sum of the parts approach. If we refer to CFA curriculum, then in CFA curriculum they expect, and that's very interesting fact, in sum of the parts approach, they expect that the value of this holding will not be just sum of 4 values for each farm, because the holding will have probably something that they call conglomerate discounts. That means that if we combine 4 farms, that we expect that they will not be as efficient as four separated businesses, and they will lose some value because of this combination. Why that's funny? Because in most models for M&A, and M&A mergers and acquisitions are done to buy a business and to create a conglomerate, to make our business a combination of what we had before and what we bought as an addition. And in most models for M&A, you will see that you buy a company and you have not conglomerate discounts, but conglomerate premium, because you expect that this combination of two businesses will have some additional economic effects. You'll have some something useful from this combination, and these two approaches exist at the same time without any conflict. So in valuation of an existing combination of businesses, we apply conglomerate discounts. But when people try to prove that they should buy a company, should acquire a business, they always talk about a premium from this combination. But this is just a general approach, and in approaches like that, we always have such problems because there are conflicting expectations about any action on the market, anything you do for your investments. You asking about a break? 1 second. I don't see time. Okay, it's 8:20. Okay, let's make a break, and let's meet again at 8:30. Okay. Lecture slides. I started my lecture from this. One second. I'll put this link again. Here's the link. You should go there, register for this website, and one second. I promised you to give you a code. And then to register for this course, you will need this code, invitation to 2021. In this, this is just my LMS system. In this LMS system, you can find curriculum for the course, lecture slides, and quizzes that you should pass after the lectures. I'll have a question for you for this lecture too, and after each lecture you'll have some questions. Okay, so you can go there, register, and everything is there. Okay, so 10 minutes break. Okay, we have 2 minutes until the end of the break. Konstantin, you asked about some real data. Do you mean real data in our project? In which task? In quiz? Yes. I'll explain you at the end of this lecture. I'll explain you the question for the quiz. And while we're waiting, we have one minute. While we're waiting, I'll show you, for those who, second. For those who want to see what it looks like. By the way, when you log in to this LMS system, or when you first come here, you can probably get it in Russian. So switch language here. So you can switch the language here to English, then it remains English. And here you can find syllabus for the course, slides for our first lecture, and the first quiz. And those quizzes, they are not exams. So they are not for with time restriction or attempts restriction. They are for me to get feedback from you, and for you to try and do something and to see that you maybe don't understand something before you see that on your exam or on your practical work. So this is just sort of feedback that replaces in some way our physical communication when we do it face to face, because in face to face training education, we can discuss it in class much easier. Here, mostly I don't see you. I don't understand what you do in there. That's why those quizzes, but they are not a part of exam or test. They are just required feedback. Okay, let's go on. So we discussed general approaches to valuation, and now let's go to the first possible method to value a company: dividend discount model. With dividend discount model, we look at the share just like we look at the bond, and we say, okay, why do I buy a share? I buy a share to get dividend. And actually, if I imagine a share that doesn't pay dividend, never pays dividend, then this share has zero value, because it just doesn't do nothing good for me as an investor. So now or in the future, I should expect that this share pays dividend. And if we now simplify this idea to a much more naive idea, that the company that we are analyzing now is very stable. It works now the same way it will work in the future, then the dividend that paid by this company now can be used to calculate the price, the fair value for their shares, right? The first problem, that's before we go to all dividends, the first problem is that actually there are many companies that don't pay dividend, and that doesn't create any problem for their shareholders, even if shareholders prefer to get dividends. Why? Because there are actually two ways to get some profit from your investment, to get dividend. The first is classically, the company declares dividends and pay those dividends to all shareholders. It looks simple, quite straightforward, but it can create some problems for the investors. Imagine, I know those problems from my own experience, and if you invest something in shares or bonds, you probably saw the same problem. You created a portfolio, you invested money in this portfolio, and you expect that this investment, this money, will be invested in these shares for some time. And for example, you invested money and you decide, okay, next time I'll come back to this portfolio and analyze it again and maybe change something in this portfolio in 3 months. Okay, you invested money, but a week later, one of your portfolio companies pays dividends, and some of your investments go from shares to cash. So this money, the money paid by this company, is not your investment anymore. I mean investment in shares. It's in cash, and you should either go to your portfolio and reinvest those money to something right now, or this amount will be frozen in cash, losing profit for you, right? So dividends are a natural way to create return for investors, but not the most convenient way. That's why many companies decide not to pay dividends at all. What do you do? How this does it work? The principle is very simple. Look, if I buy 1,000 shares, $100 each, my investment is $100,000. And if at the end of the year, the company decided to pay 5% dividends, then this company pays $5,000 to me in cash. And I have no choice. I get this money as cash. But instead of this, the company can decide not to pay dividends at all. What will happen then? Then those $5,000 will remain on the company balance sheet. And with this this additional $5,000, my shares, each of my share will have value $5 more than before. So instead of having 1,000 shares with price $100, I have now 1,000 shares with the price $505, right? And now I can decide if it's okay, and I'm going to continue with this investment. So I'd like to keep this money on this company, on this investment. Then I do nothing, and I have $500,000 for $5,000 portfolio, invested in this company. But if I like dividends, what should I do? I can just sell some shares. I can sell 50 shares, which gives me $5,000, and I will have after that I will have 950 shares. But as their value is higher now, value of each share, I will still be with $100,000 investment. And I took my $5,000 of dividends that I created for myself. That's how a share repurchase work. Why it's share repurchase? Because I sell these shares. I'm not always. I don't always sell these shares on the market. I cannot sell them just on the market. In this case, there's no share repurchase. But if there's no enough market for these shares, the company can say that, okay, we buy those shares. We are ready to buy for this investment up to 5% of your investment in shares. So I decide, and each investor separately decide, do they get dividend, or they automatically reinvest those dividends in their shares. That create a more convenient environment for the investment. And that's why many companies decide not to pay dividend. And even in absence of free market, they can declare share repurchase. And with share repurchase, they offer you to decide, will you get a dividend, or will you reinvest your money in their shares? So this is how it works. But this creates a big problem for us, because if the company is involved in share repurchases, then the number of shares is changing, always changing. First, and second, we don't see cash dividends as dividends. Instead, we see them partly as dividends sometimes, and partly as share repurchases. And those share repurchases should be calculated, taking into account changing number of outstanding shares. So if we have these buybacks, we have a problem with DDM. We have some problems with DDM model all the time, but in this case, we have this problem even mathematically, even theoretically, because the stream of dividends consists of complicated parts. So basically, we use DDM model only for companies without practice of share repurchases, and of course only for companies paying dividends. And these are maybe, I don't know, 20%. Sometimes for Russia it's more. For Russia, maybe 30% or even more of all companies pay dividends. But for the United States, for example, it would be 20% or lower, or maybe 10%. I didn't check it, but the number will be something like this. Okay, but if the company doesn't use buybacks, if the company pays dividend, then for a single holding period, for a year, for example, I can say that the value of a share of this company can be calculated with this formula. First, in a year from now, we expect to get some dividend. And with required rate of return that we set for this company, of course, current value of this dividend can be calculated as discount for 1 year, that is expected dividend over 1 plus required rate of return. And a year from now, this share will have some price. And if we buy, if we sell this share a year from now, then this price should be discounted as well and will be added to our current valuation of this this share. So this is how we calculate value for a share for 1 year. What if we hold this share for several years? Or what if we want to calculate this expected price a year from now? Then the formula changes. For example, for 2 years, we hold this share for 2 years, so we get 2 dividends for the first and second year. Our first dividend, our second dividend, and after 2 years, we again sell this company and get the price 2 years from now. And if we now imagine that we hold this share for many years, then this formula continues, and eventually we get this formula. So the value of any share can be calculated as discounted expected dividends paid for this share for the infinitive period. And this is important. We expect that we hold this share forever, and if we analyze all the expected dividends from this share, then this is the value of this share. Even if we sell it after 1 year, this price after 1 year or price after 2 years will be determined by the future dividends of the company. So in any case, for any holding period, the value of the share determined by expected dividends for the whole period of existence of this share. Okay, but this is too complex. We cannot forecast 1 million years of dividends and so on. Yes, but we can simplify our expectation about those dividends. And the first simplification we can do, what if we believe that future dividends are equal to current dividends and they grow with some constant growth rate? So we have G, for example, 5%. And we believe that if the company paid $1 dividend per share this year, then the next year it will be 1.05, then 1.1 or 1.11, yes, with 5% growth, and so on. So each year the dividend grows with some constant growth rate. If so, then the formula for this dividend will be a bit simpler. instead of this that we cannot just calculate because we have millions of expected dividends, we get just this simple formula. So if we believe, then the company will pay dividends every year in the infinite future, dividends equal to our last dividend, growing each year with rate G, and our required rate of return is R, then the value of this cash stream will be D0. D0 is the last dividend paid by the company, times 1 plus G over R minus G, or we can put it this way, D1 over R minus G, where D1 is expected next dividend. And of course, from the idea of constant growth rate, we can say that expected next dividend is equal to last dividend times 1 plus G. This formula is called Gordon growth formula. And this is the most important formula in the whole valuation. This formula is used in many other methods, in many approaches. So if we believe that some revenue stream, income stream, has just constant growth rate, then the value of this stream can be calculated based on Gordon growth formula. So to calculate value of any share, now we need just those three parameters. The first one, D, dividend, is taken from the company's financial reports. So what they paid last time is their D0. The second parameter, R, or required rate of return, will be the main topic of our next lecture. We'll be discussing the principles of return, of how we calculate discount rate, and so on. And the third parameter is growth rate. And what do you think? If we believe that the company will grow, the business will grow, the dividend will grow with some constant rate, what would be that constant growth rate? What it can be? Imagine that the company we are analyzing is something like, we'll be discussing some slides later, Детский мир. Детский мир is a retail network. So retail, a big retail network. Why does this company grow? I think there are three possible reasons. First, inflation, very natural reason. This is not real growth. This is just monetary growth, but it grows, right? So the first reason why the numbers change in our financial reports is inflation. And by the way, sometimes in many cases, actually, valuation is done not in nominal terms, but in real terms. That means that we ignore inflation, but we'll be discussing that later. If we use nominal terms, that inflation is the first reason why this company grows. And it's very actual to prove and explain, right? If I present you my calculations for the value of the company In this valuation, I say that I expect constant growth rate equal to inflation. This is something that I actually don't need to prove. That's obvious. Inflation changes our cash flows. Okay, second reason why the company can grow is because the whole economy is growing. If the whole economy is getting bigger and bigger, and I can still hold my market share, then I will grow. And the question here is, does some average economy grow constantly? Is it the case? I think yes, because we're looking at the at all world economies, and we can see that they have GDP that growing constantly. And you should know that GDP growth is in real terms. That is, GDP growth doesn't include inflation. If I see that some country has GDP growth of 2%, that means that without inflation in real terms, it grows 2% a year. And if I can sustain my market share in this economy, that probably my business will grow with the same rate. So this is another possible reason why my business is growing. And I would say that with this driver, this driver is quite sustainable. And I can believe that this driver will remain a driver for my company for dozens of years. So it's okay to include this type of growth in my long-term constant growth rate. The third possible reason why my company is growing is because on this market, I win more and more as a market share. So I can grow faster than the market. Yes, that's okay. But the problem is that in my formula, this is not a growth rate for 5 years or for 10 years. This is constant growth rate. And if I believe that my company is growing faster than the market, that means that at some point in time, I will get the company that has more than 100% of market share, which is not very plausible, right? So this third factor is a bad part of my growth rate. And that's why generally, for most cases, I can expect that this growth rate will consist of GDP growth plus inflation. Okay, so just a couple of terms. Because we had 2 versions of this formula with D0 and D1 dividend for the last year, last paid dividend, and the next expected dividend. And more for exam reasons, if you're preparing for CFA exam, you should remember that D1 is called forward dividend. So the forward dividend is the number that we expect to get in 1 year. And D0 is trailing dividend. the number that we received right now. And of course, when you work with a real company, you won't have D0 received yesterday and D1 received in 12 months. So the life is more complex. So sometimes you will see questions to understand this idea. We'll discuss forward and trailing parameters later when we'll be discussing relative valuation again. But for dividend, you can see these questions as well. And this idea of D1 and D0 is often used as a trap in exam questions for CFA. Okay, but we just understand that we have these two types of dividend, and now we need GDP forecast. And with GDP forecast, you can, of course, use very sophisticated sources of information to forecast dividends. And you can see from this example that forecast GDP. You can see from this example that in any country, GDP growth, both historical and short-term forecasts for GDP growth, can vary quite widely. And for Russia, for example, for the last 20 years, you could find GDP growth from -7% to +9%. But you shouldn't use these short-term forecasts, because we use this as our constant growth rate, as a part of our constant growth rate. So we need a very long-term GDP forecast. And with this long-term GDP forecast, the life actually is very simple. I'll skip this one. And you can see that for most economists, maybe except places like China or India, and India maybe less. It was also Russia and Brazil when they created the term BRICS, but both Russia and Brazil now fell to this normal way of expectations for GDP growth. And for all countries except countries like China and India, long-term GDP forecast is very close to 2%. So these numbers, your growth rate for DDM, for discounted dividend model, will be between inflation and inflation plus 2%. And I can promise you that if you take any number outside this range, inflation and inflation plus 2%, it will be very hard for you to prove your point. So there will be augments, and your model, your calculation will not be that effective as a way of communication of your ideas, of your vision. So you can expect that your growth rate is between 0 and 2%. 2% is the most optimistic forecast. And then you add a long-term inflation forecast. For Russia, it's 4%, because this is target inflation rate set by the Bank of Russia. Although they cannot always hold inflation, but they try, and they more or less successful in that. So this is what we can use as our growth rate. Now, we can look at this growth rate from the other point of view, I looked at the general economy, and I said that the company cannot grow faster than the market. So the first we did, we calculated how fast can the market grow, but how fast can the company grow? Imagine that you have a good company, profitable, everything's okay with this company, but the problem is that this company pays 100% of its profit as dividends. If you pay 100% of your profit as dividends, that means that your costs, the costs you pay in your business, cover your necessary operating costs and your depreciation, right? So you spend enough money to operate and to buy new assets to replace old assets, to replace assets, equipment or plant that you cannot use anymore. But where's the growth here? To grow, you need to produce more, not in terms of inflation, but in terms of real growth. You need more equipment. You need to grow in terms of your assets, right? And to grow in your assets, you have to invest more in your business, right? So from this idea, I can draw the following conclusion. The company cannot grow constantly if it doesn't invest money in this growth. Because the company uses assets, uses equity to grow, I will make the following assumption. Return on equity will be stable for this business because this return on equity comes from the nature of this industry. So the company can sustain growth only at the rate equal to earnings retention rate times return on equity. Because if I reinvested something in my equity, then I get more return on this new equity. And this is how growth is created by the company. So if the company has retention rate 0 or dividend payout ratio 1, that means that all the profit is paid as dividends, then this company doesn't grow. It cannot grow. You can grow for 1 year, for 2, for 3 years. You cannot grow for 100 years. To grow for 100 years, you should always reinvest something. And that's why you will not see a company that pays 100% of its profit as dividend, because the company has a choice. It can invest in future growth, or it can pay its profit as dividend. And all companies usually balance between those two sources of value. And of course, if we go back to the formula, you can see that with higher dividend, you have higher D1 or D0, so your value will be higher, but your growth rate will be lower. That means that that reduces your value. So the most balanced approach is to invest something in growth and pay something as dividend. And usually you can see growth rate of dividend payout ratio like between 30 and 60% of net profit for all companies. That's because they creating their future growth with this retention, with this reinvestments. And of course, for our calculations, for our valuation, we use the minimum of those two numbers: sustainable growth rate and the growth rate defined by the market. So this is the general approach, and this is the practical part of DDM model. And now let's quickly go through some formulas and ideas that we can draw from this basic formula. First, talking about growth rate. We said that growth rate can be calculated as retention rate times return on equity, because return on equity can be presented using DuPont equation, where return on equity is equal to profit margin times revenue, turnover of total assets turnover times financial leverage. That is net income over revenue, revenue over total assets over equity. Then we can use this formula for our formula for G, and present G as net income minus dividends over net income, which is retention rate, times this DuPont equation. That is not very practical. That is something that you should know for exams like CFA. And by the way, just to say it now, I will not use formulas like this on my exams. So that means that I don't believe that you should know formulas like this by heart. We use only the basic formulas, the formulas that are practical and that used in real work. And with this idea, let's now take a real company, Interral. Interral is a Russian power network company, and here is information about their dividends. And now let's open a model, a very simple model for this Interral data. Here you will see something that you need to apply DDM for your calculations. So the first thing, for Interral, we don't have yet dividend for 2020, because they declare dividend for 2020 somewhere in May, I think. So let's use 2019. But by the way, you can see that this is the first problem for you. Practical problem. We expected that D0 is something that we received as dividend yesterday. But in this case, this is something that we received as dividend nearly a year ago. So this is not actually D0, but okay. Let's calculate value of this company for the 2nd of June in 2020. This is a problem, but we can ignore it for now, right? Igor, are you asking about Interau as? Yeah. Okay, we'll discuss it now. Okay, so here is our Interau dividends. We have dividend per share for each year. Let's go to a very simple dividend discounted dividend model. This is, by the way, this is current price for today for Interau. And the first problem for me is that I have several years with different dividends, and I'm afraid that probably the last dividend isn't the best way to represent stable dividend policy of this company. Maybe from year to year, they change this policy a little bit. Their profits maybe fluctuate and so on. So to use just one dividend from the last payment looks too risky. So the first thing I do, I take 3 years. I took 3 years from 17 to 19, and I calculated average dividend. So let's say that on average, this company pays this dividend. Of course, that creates some raise some questions for me, because average between 17 and 19 doesn't include inflationary changes and this growth that I expect for this company. So it looks not very correct. And the answer for this would be somewhere between using the last dividend or using average dividend, or maybe even using average dividend changed for my expected growth rate and so on. This math can be different, and it will be still within the general approach. So DDM method doesn't require one or another approach to how we collect data about our dividends. So yes, and payout ratio can be changed as well. So the first step, I calculated this average dividend. The next thing, okay, let's just do a very simple thing. Let's create our formula. So our formula would be this average dividend. We believe that we received this dividend yesterday, and Gordon Growth formula is here. With required rate of return equal to 10% and no growth rate, I get 1.66. If I believe that the growth rate will be just expected inflation, I get fair value then 2.88. If I believe that the growth rate will consist of inflation plus 2% of GDP growth, then I put 6% here, and I get roughly the current price. So this is how this formula works. And I saw some questions about this company. And those questions are still outside of this formula. Those questions are, what if the payout ratio is changing? What if this company has much higher growth rate than just inflation plus GDP. What if those three dividends are not something that will be repeated in the future, and the company expected to change profitability, to change dividend payout ratios, and so on. But this is DDM. DDM is a simplified approach. If you need deeper analysis, we'll go to other approaches. But even with DDM, we still have some more theoretical versions of DDM approach. But I would like to underline this thing. Now we'll go through several formulas, other approaches. They are actually quite rare in real life, just because if you believe that simple DDM is too simple for you, then you will probably go to DCF valuation, to free cash flow, to what we'll be discussing the next 2 or 3 lectures. DDM usually is for this very simplified calculation. But let's go to some other formulas. Again, just for the exam, if you have a formula for growth, for your value based on dividends, growth, and required return, but you know that the company has some value, like in this case, we know that 4.97 is the current price for its shares. From this fact, we can rearrange the formula, and based on the current price, we can calculate what growth rate is expected by the market. In this case, if we believe that the market uses, on average, the market uses 10% as their required return, then we can find that the market believes in something like this. 6.45% is the growth rate used for valuation by the market. And now we can compare this expectation with what we believe about this company. So instead of forecasting one growth rate, we can just analyze the growth rate implemented in the market valuation, the price that was set by the market, and think about this growth rate and decide, do we believe in this growth rate, or we think that the growth will be lower. Another thing we can create from this formula is a thing called present value of growth opportunities. And what is the present value of growth opportunities? Let's return to the formula again. I started with 0 growth rate, and with 0 growth rate, with what we received as based on the dividend, now we have value 1.66. This is what we have right now. And with 6% growth, we have 4.4 as valuation. In this 4.4 consists of 2 parts: of current earnings generated by the being generated by the company, and of expected growth and bigger earnings in the future. So this part we call present value of growth opportunities. Again, this is just a question for CFA exam, popular question. The same way, if we know the growth, we can calculate required return used by the market to value this company. So we can use this formula in these several ways. But as I mentioned, the problem with the formula is that this growth rate should be stable, should be one constant growth rate for the whole life of the company. And that's not always the case. That's actually rarely the case. Because of that, people created, we'll skip this slide. People created some other versions of DDM, a bit more sophisticated versions. First, two-stage DDM. Okay, if the company is fast-growing company, then probably we can say that for some years it will remain a fast-growing company, and for this short term, this company will have a bigger short-term growth rate. But we cannot use this high growth rate for the whole life of the company. So after some years, the company will fall from this short-term growth rate to a smaller long-term growth rate. And we define this long-term growth rate based on things like inflation plus GDP. But for short-term, we use higher growth rate. And this is the formula we get for this version of forecast. Again, I don't ask you to remember this formula, but if you go into sit for CFA exam, you should learn it, because for sure you'll have this formula on the exam. This is what they like to put on the exam. For example, Nike. Nike is a fast-growing company, and this creates a problem for you because they have like 12% growth rate. You cannot analyze this company with 12% growth rate, because your required rate of return may be like 9 or 10%. And if you use growth rate higher than required rate of return, you get senseless formula, right? So you need to limit this high growth period. And for valuation of Nike, we can use like 3 years of high growth, and then we expect a long-term growth rate of 6%, for example. And this is how we calculate valuation for Nike. And then we can go one step further and say, that look doesn't a real forecast this one with two-stage growth rates. Why in after 3 years Nike should fall from 12% to 6%? That will probably happen not this way. They will gradually change their growth rate. Okay, so let's suppose now that the company has growth rates changing from current high growth rate to some long-term lower growth rate. From year to year, gradually, this growth rate is changing. Then the formula for this value would consist of 2 parts. First, the value determined by this long-term growth rate. And this is just Gordon Gross formula, Gordon Gross equation as we know it. We just use the dividends, in this case, D0 times 1 plus G over R minus G. And in addition to that, we have this triangle. And this triangle has value, generates value that can be calculated with this formula. And because in this formula, there's a half-life of the half of this period used as H, the whole model is called H model because of this parameter. So again, it looks quite complicated. Sometimes people use it, but very rarely. But for the exam, you can expect this formula too. And eventually, we can make it even more complex. We can say that for some years, we expect that earnings per share will change with some trend that we can predict, we can analyze and predict. And payout ratio will change with some trend that we can analyze and predict as well. So for this period, we will forecast earnings per share or its growth and then calculate from its growth earnings per share. We can forecast the payout ratio, and through this forecast we can calculate expected dividends, for example, for 5 years or for 10 years. And then the company comes to a steady state where we use just general Gordon growth model. And with this approach, we can apply discount dividend model even to a company that, for example, doesn't have profit now or doesn't pay dividends now. Like in this case, you can see that for first 2 years, the company has 0 payout ratio, so it doesn't pay dividends. But then it starts paying dividend, and we have working DDM as a result. So we can apply this more complex version of DDM, and actually this is like a first step toward free cash flow analysis instead of just DDM model. You can see the approach like this. For example, if you use Icon, in Icon, you will have something like this for the companies there. They have this standardized, simple DDM model based on the idea that they forecast EPS, earnings per share, forecast dividend payout ratio, calculate discount dividend. They do it for 10 years. First 5 years, they forecast more detail. Then they use just growth raised. By the way, sometimes they use 15. Here it's 15 years. For other companies, they use 10 years total growth rate, total detailed forecast. And after that, they use something like 6% here as growth rate for steady period, 50% payout ratio, and calculate the value of the company. This is a very simplified approach. It as simplified as probably just DDM with 1 dividend for the last year, but you can find this version in Icon for most companies. I wouldn't believe too much in calculations done this way, but this is one of the approaches. Okay, and now the last thing for today. So we discussed how we calculate share price using DDM. Now let's take Detsky Mir. I mentioned it. Mentioned Detsky Mir. Let's take Detsky Mir. Detsky Mir is a retail company, retail network paying dividend, and we can try to calculate fair price for the share of Detskiy Mir. So by the way, you can see that their price is pretty stable. This is last 3 months. They don't change too much. They slowly growing. So this is a good example to use DDM as an approach. On their investor relations website, we can find their dividends. So for this company, for this example, the question for you is very simple. Is Detskiy Mir undervalued or overvalued today, according to your estimation based on DDM? In the LMS, you have assumptions for required return, for growth rate. So what you need is to build very simple calculation of value or of price of the share and compare it to the current share price and give me your answer in the system. In the system, you need to upload your calculation as a small Excel file with this calculation, and you'll get feedback for your calculation in the system and in the next lecture. And by the way, here you can see that the first problem is that Detskiy Mir, in contrast to Interau that we discussed, Detskiy Mir doesn't pay dividends once a year. It pays dividends twice a year. So you should think about this fact. You should think about how you will use this in your calculation, and then try to calculate it and tell me what's going on with Detskiy Mir. Should we buy it or sell? So that's it for today. I expect to see you in LMS and see your answers, and see the next Tuesday. Yes, it's Tuesday today, and see you the next Tuesday. Bye.